Welcome to The Explainer. Today, we're pulling back the curtain on something huge. A company's supply chain isn't just about trucks and boxes. Nope, it's the hidden engine that really drives financial performance, and we're about to show you exactly how it works. And this quote right here, this is the big idea for our whole journey today. It's so simple, but it's incredibly powerful. Supply chain decisions aren't just operational, they are financial. Every single choice, from who you buy from to how you ship a product, leaves a clear financial fingerprint on the company's books. All right, so here's our game plan. We're going to start with the big picture, then we'll break down the three key financial pillars one by one, and then we'll put it all back together to see this incredible domino effect in action. Let's get into it. So, how do we actually see this connection between operations and finance? Well, we look at the three core pillars of any company's financial story: the balance sheet, the cash flow statement, and the income statement. You can think of these as our windows right into the engine room. Think of these three as the main dials on a company's financial dashboard. You've got the balance sheet, which tells us what a company owns and what it owes at one specific moment in time. Then there's the cash flow statement, which tracks the actual real cash moving in and out. And finally, the income statement. That's the final scorecard of profitability. And the craziest part, the supply chain manager has their hands on the controls for all three. Okay, let's dive into our first pillar, the balance sheet. This is literally a snapshot of all your stuff. And this is where all those decisions about physical things, we're talking inventory in a warehouse, the factory itself, show up directly in the company's financials. The big concept to get your head around here is net working capital, or NWC. Honestly, the easiest way to think about it is stuck cash. It's the money that a company has already spent on things like raw materials, but it hasn't gotten back from its customers yet. So naturally, the goal is always to keep this number as low as humanly possible, because that frees up cash for everything else: growth, R&D, you name it. And here is where the rubber really meets the road. Let's take a strategy like vendor managed inventory, or VMI. This is where you let your supplier manage the stock at your own facility. The brilliant part is that inventory doesn't officially belong to you until the moment you use it. So just like that, poof, it disappears from your balance sheet. That lowers your assets and frees up your cash. Now, this also works on the other side of the equation with liabilities. If you can negotiate longer payment terms with your suppliers, it's basically like getting a short-term interest-free loan. That also brings down your net working capital. And bigger decisions, like outsourcing all of your manufacturing, that completely transforms your balance sheet by getting rid of huge fixed assets like factories. Even investments in things you can't touch, like new supply chain software, show up here as an asset that gets its cost spread out over several years. They call that amortization. Okay, on to our second pillar, cash flow. And this one's critical. It's not just about how much money you have, it's about the timing of when that money comes in and goes out. I mean, a company can be wildly profitable on paper, but still go bankrupt if it runs out of actual physical cash. The single most important metric for tracking this is the cash-to-cash cycle, or C2C. It's purely a measure of speed. It asks a simple question: how many days does it take for the dollar you spend on raw materials to make its way all the way back into your bank account as a dollar from a customer's sale? It's pretty obvious, but the shorter that cycle is, the healthier the company's cash situation. So this C2C formula gives a supply chain manager three incredibly powerful levers to pull. First, they can reduce how long inventory is just sitting on a shelf. Second, they can find ways to get customers to pay them faster. And third, they can negotiate to pay their own suppliers slower. Pulling any one of these levers directly shortens that cycle and just pumps cash right into the business. And what's wild is that pulling these levers doesn't just affect one thing. It impacts every type of cash flow. Improving your C2C cycle, that directly boosts your cash flow from operations. That decision to outsource manufacturing, well, now you're not buying factories, so that changes your cash flow from investing. And if you have more cash on hand, you need less debt, which improves your cash flow from financing. You see, it's all connected. All right, let's bring it home with our third and final pillar, the income statement. If the balance sheet is a snapshot and cash flow is the company's lifeblood, then this is the final scorecard. This is what answers the ultimate question: after everything is said and done, did we actually make any money? Now, one of the key strategic choices in supply chain is deciding where your costs even show up on this scorecard. For example, if you outsource manufacturing, All of your internal production costs, like labor and materials, get bundled into one single line item, cost of goods sold. But then all the new costs of managing that supplier, things like audits or holding extra safety stock, those pop up under operating expenses. So you see, it's a strategic trade-off. But listen, a great supply chain isn't just about cutting costs. Not at all. It can be a revenue-generating weapon. Being fast and agile, that means you beat your competitors to the market and you capture those valuable early sales. Being reliable and high quality, that means you can charge a premium because your customers trust you to deliver every single time. And this is where supply chain becomes a really high-stakes financial game. Just imagine a global company. They make a product in country A, where taxes are super low, and they sell it in country B, where taxes are super high. The supply chain team gets to decide the internal transfer price, basically what the sales office in country B pays the factory back in country A. By setting that price strategically, they can directly influence how much profit gets declared in the high-tax country versus the low-tax one. They're literally shaping their global tax bill. Okay, we've looked at all three pillars in isolation. Now, for the fun part. Let's connect all the dots and see how one single supply chain decision can set off a powerful chain reaction across all three of these financial statements. Let's trace the dominoes using our VMI example again. So, step 1, the decision is made, and it immediately hits the balance sheet by lowering your inventory. Step 2, that lower inventory instantly improves your cash flow by shortening that C2C cycle. Step 3, now with more cash, you don't need as much debt, which means you're paying less in interest, and that shows up on your income statement as higher profit. And finally, step 4, that extra profit flows right back to the balance sheet as retained earnings, which increases the company's total value. See that? One single operational choice creates this beautiful, positive cascade across the entire financial system. So the next time you look at a company's financial report, I hope you don't just see a bunch of numbers. I hope you see the story. You see the operational choices, the strategic trade-offs, and that hidden engine of the supply chain humming away in the background. The only question left is, what story is it telling you?